So here we got exercise 5-11. Again, I was moving backwards because I wanted to show the easier stuff first. Calculating the predetermined overhead rate, applying overhead to production, reconciling overhead at the end of the year, which we already did, adjusting cost of goods sold for under and over applied overhead. So at the beginning of the year, this company estimated the following. So they had overhead of this amount and they had direct labor hours of 320,000. They used normal costing and they apply overhead on the basis of direct labor hours. Perfect. For the month of January, direct labor hours were this amount. So this was the actual. By the end of the year, they showed the following actual amounts. So now they show the end of the year. Assume that unadjusted cost of goods sold for Potter was this amount. So the very first thing we're going to do, we're going to jump in right away. We're going to calculate the application rate. And they're using the plant-wide, right? Because there's no departments. We already know how to calculate this. I've covered this. We're going to do the estimated manufacturing overhead in dollars, and we're going to divide it by the estimated total cost driver, right? So we're doing the exact thing that we did before. I'm just going to merge and center, and I'm going to put a line underneath it. There we go. Okay, so we know this already. So let's just calculate it. We know the overhead estimated is 864,000 and the direct labor hours is 320,000. And so that means our application rate is going to be 2.7 per direct labor hour. So for every direct labor hour, overhead is going to be $2.70. I'm going to just change it into that. There we go. Now, calculate the predetermined overhead rate. Done. Calculate the overhead applied to production in January. So remember, when we look at applied manufacturing overhead, what do? We take the application rate and we multiply it by the actual cost driver. So in this case, the actual cost driver, of course, is direct labor hours actual. So now we know how to do this. We're going to do the applied manufacturing overhead. We're going to take the application rate, 270 per direct labor hour, and we're going to multiply it by the actual direct labor hours for January, 7,950. So 7,950 direct labor hours, and this is going to equal the amount that's applied. There we go. That's dollars. $21,465 is going to be applied. Perfect. So now we know what was applied in January. Calculate the total applied overhead for the year. So don't forget, this was applied manufacturing overhead for January. Now we want the applied manufacturing overhead for the year. We're going to do the same thing. We're going to take the $2.70 direct labor hour. We're going to multiply it by the total direct labor hours for the year. So it says down here, direct labor hours for the year was 330,400. Direct labor hours. So what is that going to equal? It's going to equal what was applied to every single job for the whole year. And again, this is dollars. So applied was $892,080. So now, if we have our manufacturing overhead account, remember that the actual goes in as positive. Actual right here is 904. That's dollars. The applied goes in as a negative. Okay. Now, is it under or over applied? This was the actual. This was the applied. It's under. Because this is what we should have applied. This is what we did apply. And so this is under. Remember, you have to ask yourself, always, always, always. You have to say, this is what I should have done. This is what I actually did do. So this is under applied. If it's under applied, it's under costed. And if it's under costed, we didn't charge enough. So now we know that this is sitting in the manufacturing overhead account, right? And we didn't apply enough to the cost of goods sold. So we're going to go over here. We're going to show cost of goods sold. And we know the balance in the cost of goods sold right now is 942,680. 942,680. That's what's sitting in there right now. Now, remember that this was under applied. There's a balance sitting in the account because we didn't apply enough. So are we going to add it to the cost of goods sold, or are we going to deduct it? Now, I'm going to remind you again, this is what we should have applied, but we applied less. So we have this amount left over. Are we going to add it into the cost of goods sold, or are we going to deduct it? Is this cost too high right now, or is this cost too low right now? So it's too low. Remember, if it's under applied, this means it is under costed. If it's under applied, it's under costed. If it's over applied, it's over costed. And if it's under applied, it's under costed and we have to add to the cost. So we're going to add to this cost and the cost of goods sold is going to go up. This is why it's so important to be able to understand if it's under applied, because if it's under applied, it's under costed. Our cost of goods sold is too low. We got to up it. If it's over applied, it's over costed. We got to reduce it because it's too high. So this is why understanding when it's under applied and when it's over applied is so critical. And remember, you just got to say to yourself, this is what actually we should have done. This is what we did do, and it was too low, right? And previously, when we had it over here, this is what actually we incurred. This is what we applied. Well, we applied way too much. This is what actually happened. This is what we applied. We applied too little. Okay. And that will tell you whether you have to add it into the cost of goods sold or deduct it from the cost of goods sold. In this case, we have to add it. It was under applied. We're going to add it. Over applied, we're going to deduct it. And then it says, what is meant by an overhead variance? A variance means that the actual and the applied do not equal each other. We already know how it's calculated because we calculated it right here. And what happens to it at the end of the accounting period? We have to eliminate it. At the end of the accounting period, it's got to be a zero balance, right? And we eliminate it by moving it into cost of goods sold, either adding it if it's under applied or deducting it if it's over applied.